The Roaring Twenties were a decade of prosperity, jazz, and relentless optimism. America was electrified by new technologies like the radio, the automobile, and the airplane. Cities boomed with skyscrapers, rural families bought Model Ts, and Wall Street became a symbol of unlimited opportunity. Ordinary Americans were buying stocks in record numbers, convinced the market could only rise. The national mood was one of triumph, and speculation became a way of life. But beneath the glamour and optimism, dangerous forces were building. By 1929, stock prices had become completely detached from economic reality. Banks lent freely to speculators, margin debt exploded, and Wall Street's machinery was running faster than ever. The illusion of endless growth came crashing down in October of that year, when the stock market collapsed in spectacular fashion. The 1929 crash did more than destroy fortunes. It triggered the Great Depression, the worst economic downturn in modern history. To understand how the crash happened, we have to look at the culture of the 1920s. This was an era when technology, mass production, and advertising created an explosion of consumer demand. Companies like General Motors and RCA became household names, and their stock prices soared. Newspapers encouraged Americans to invest, portraying the market as a ticket to wealth. Brokerage houses opened branches across the country, so small-town citizens could trade alongside the wealthy. One key driver was the rise of margin trading. Investors could buy stocks by putting down just 10% of the money and borrowing the rest. This leverage magnified gains, but it also magnified losses. If stock prices rose, the investor made a fortune. If they fell, the investor could be wiped out overnight. By 1929, millions of Americans were investing with borrowed money, creating a market built on speculation rather than fundamentals. Wall Street itself became a circus of excitement. Crowds gathered outside the New York Stock Exchange to watch ticker tape roll by, following the latest quotes. Rich and poor alike were drawn into the frenzy. Even shoeshine boys and waiters were rumored to be giving stock tips. Economists and financial writers warned of overvaluation, but few wanted to listen. The Dow Jones Industrial Average rose from 100 points in 1924 to over 380 by September 1929, a nearly fourfold increase in just 5 years. The crash came in stages, with a sense of dread building as the month of October unfolded. On October 24, 1929, later known as Black Thursday, selling pressure surged and the market dropped dramatically. Crowds gathered outside the exchange as panic spread. Major bankers met to organize support, pooling money to buy blue-chip stocks in an effort to restore confidence. For a brief moment, it seemed to work. Prices stabilized, and newspapers reassured the public that the worst was over. But the calm was short-lived. On Monday, October 28th, the market crashed again, this time even harder. The Dow fell nearly 13% in a single day. The following day, October 29th, Black Tuesday, chaos engulfed Wall Street. Over 16 million shares changed hands, an unprecedented volume that overwhelmed ticker machines and left brokers unable to keep up. Prices collapsed across the board. General Electric, General Motors, RCA, and US Steel all fell sharply. The Dow dropped another 12%, and billions of dollars in paper wealth evaporated. The human toll was devastating. Investors who had bought on margin were forced to sell, often at catastrophic losses. Banks that had lent money to speculators faced defaults and runs. Ordinary families saw their savings wiped out. Stories spread of suicides on Wall Street, though many were exaggerated. Still, the psychological blow was immense. The belief that the market could only rise had been shattered forever. The crash did not cause the Great Depression on its own, but it acted as the spark that ignited a global downturn. Banks failed by the hundreds, credit dried up, and businesses slashed production. Unemployment soared from 3% in 1929 to nearly 25% by 1933. Farmers lost their land, factories closed, and bread lines stretched across city streets. For many, the American dream seemed to vanish overnight. Wall Street's reputation was destroyed. Once seen as the engine of prosperity, it was now viewed as reckless and corrupt. Calls for reform grew louder as citizens demanded protections against future collapses. In the years that followed, sweeping changes reshaped finance. The Securities Act of 1933 required companies to disclose financial information to investors. The Securities and Exchange Commission, SEC, was created in 1934 to regulate markets and prevent manipulation. The Glass-Steagall Act separated commercial banking from investment banking, while the Federal Deposit Insurance Corporation, FDIC, guaranteed bank deposits. The crash also reshaped investor psychology. A generation of Americans grew wary of the stock market, seeing it as a dangerous casino. Many swore never to invest again. The trauma lasted decades, and even when markets eventually recovered, confidence was slow to return. Globally, the consequences were just as severe. Europe, still struggling to recover from World War I, was dragged deeper into crisis. International trade collapsed as countries raised tariffs in a desperate effort to protect domestic industries. Political instability grew, paving the way for extremism and conflict. The crash of 1929 and the depression it unleashed set the stage for the turbulent 1930s and ultimately World War II. Looking back, the 1929 crash offers timeless lessons. Speculation and leverage can create powerful illusions of wealth, but they also set the stage for disaster. Confidence can evaporate in an instant, and when it does, even the mightiest markets can collapse. Regulation, transparency, and caution are essential to keeping financial systems stable. For Wall Street, October 1929 remains its most infamous moment. The scenes of panic, the ticker tape running hours behind, the desperate crowds outside the exchange, they have become etched into history. The crash was not just a financial event, but a cultural turning point that reshaped how Americans thought about money, risk, and the future. Nearly a century later, echoes of 1929 still linger. Every major downturn is measured against it, every bubble carries warnings of its excesses, and every investor who steps into the market must contend with the lessons of that fateful October, when the music stopped and the world changed forever.